Hey, what's up, good people? Welcome back to Stock Up with Larry Jones. Hey, welcome to the family. If you're new, hit the like, subscribe, and a notification bell. Don't fall for spam in the comment section. I don't have a WhatsApp or a Telegram, and I don't invest anyone's money. But what I do have is a class that's for you. Yes, it's called the Ultimate Beginners Class, but it's something in there for everyone. I'll talk about that later. Let's get right into what's happening. The Fed is talking again today. Well, he spoke earlier today and spoke for quite a while. And he's continued to kind of bear down, sounding somewhat hawkish. And so what I did was I kind of look around to see who expresses my sentiment of what I think is happening. And Steve Leisman, I believe that's his name. Steve, I like him because he's just well balanced. So I want you guys to listen to this. I took this on my phone, so let's see if this will work.
I would say, Kelly, some more modestly dovish remarks in day two of the testimony compared with day one. But markets seem to really not react to them and really stuck to those comments from yesterday. They also have to process, by the way, some stronger economic data. Here are some of the key remarks he made that I thought were at least somewhat more dovish. In his first answer, Powell said no decision has been made on how much to hike at the March meeting. And he said that we're not on a preset course for March and we'll be guided by incoming data. He also said slowing down the pace of rate hikes is a way to monitor the lags effects of monetary policies. Those comments are not, I would say, directly contradictory to what he said yesterday, the comments that rocked markets when he said the Fed could increase the pace of rate increases in response to data. But they do emphasize maybe the more dovish potential outcome here. While it's unclear whether he intended to take the edge off yesterday's bond yield increases, if he was trying, he didn't do very good of a job.
So bond yields, what was it, a 2-year T-bond right now, you can get 5%. 5%. And so, there is a flee to bonds right now, because if you can get 5% with almost zero risk, then why not get 5%? I mean, 4% was good. Now we're talking about 5%. That's really, really good. And so people are fleeing to bonds, and that's not good for the stock market. Let's look at what's happening at the major indices right now here 20 minutes before closing bell at the time of filming this. As we could see, the market didn't react kindly to Mr. Powell's comments today. That's what's going on. And so, like I was saying on this morning's video, higher, faster, longer. Higher, faster, longer. That's what the Fed is touting while he was talking on the Hill. And that spooked the market, spooked it for 2 days, right? 2 days straight. The question still lies, did the market overreact these 2 days, right? Not only did the market overreact to these 2 days, since CPI and PPI is coming next week, is this taking some of the blow away? Is this taking some of the sting away, right? So if inflation shows that it's still out of control and it comes in higher, consumer price index and producers price index next week, was the Fed talking lessening the blow? That could be. That's something to think about. So sometimes there is actually positive things while negative things are happening, right? And so that's what I'm looking at. Where are we in this market is what we're trying to find out, right? And so I'm not really big into bonds. I'm gonna shout out Stock Mo again on this one because he is into bonds and he went to bonds. I'm just not a big bond person. That's me. But I am going to get some bonds. And let me rewind that. I do have some bonds, but not bigly, all right? Because I like a little risk. That's me. So far, a little risk, gave me a little reward. And so I like a little risk. You trade according to you, right? And according to your age. If you're older, then you need to be more heavily stacked in the bonds. If you're younger, you can afford a little more risk, okay? So just know that. All right. So one of the things that I did buy today, and remember, this is not a suggestion for you to buy, hold, or sell, but I shared with the good people this morning, and I bought some Occidental. Okay, Occidental is what I bought. As you could see, I was buying energy and oil anyway. And when I found out that Berkshire now owns 200.2 million shares of Occidental, worth 12.2 billion, all right, based on the close on Tuesday, it encouraged me to buy some, all right, just a little. And I'm going to DCA. I also bought some options on Devon Energy, all right? And yes, it's down. I'm just sharing with you guys what I'm buying now. Just because I'm buying it, what I bought is already red. You could put it on your watch list. I'm expecting oil to go up here in a few next coming months, especially this summer. So my option plays that I bought today was based on the summer months. So I bought them far out. And I only bought one, and I'm going to babysit them over the next few days. If they go down, a dollar cost average in. Some of you guys hear stuff and you start to buy right away. I don't want you to be that reactive. Just don't go down that trail. Remember, anything you should research. Research all of energy. Research all of oil. And if you think it's going up, then you make an educated decision based on that. I plan on having some of these stock for a while, for the rest of the year. And so these are short, long-term swings for me. But let's talk about the matter at hand. Where are we in this market? And what I'm really focused on. What I'm really focused on is the long game. The long game. We can watch these markets bounce up and down day by day, and we could really lose focus on what we should be doing in this market. What I am doing in this market, and remember, this is just me. What I'm doing in this market is I am trading the market that I am in. And having said that, let me pull up the S&P. Having said that, remember, I was telling you guys that, yes, remember we had those green days and we just kept bouncing up, and everybody thought, okay, we good. Well, look at that. We went up. Everybody thought we were good. And then next thing you know, if you zoom out a month, you could see that we keep having these legs down, right? Then we pop back up and then down again. Let's go out 6 months. Let's look at what's happening, right? And so here we are. We're up in the last 6 months, but we really just got back to where we were, the high of where we were. And now we're starting this downtrend again. And we could go this low, right, in December, or we can go back to October's lows. Now, I believe, and I'm going to say this, and I'm not a negative person. I just want people to be prepared. There again, I keep looking for the lows. And I do believe before this year is over that we will visit the October lows. That's what I believe. You let me know what you believe. But I also believe that by the end of the year, we could blow past the highs of this entire year. And so I just want you to think about that and research that in your research. So what are we doing? So what I'm doing is I'm focusing on short-term plays. So short-term, I expect energy to go up. So I'm buying energy like I mentioned. And ticker symbol EOG is another one. So I'm just diversifying into that sector. That is my safety sector. And that's what I'm rolling with. Now, oil may never go up. It may just trade sideways. But it's a risk that I'm willing to take, right? You let me know what sector you're buying and what specific stock. Because right now, you have to be a good stock picker in this market. Leave me a comment on that. Also, tell me what you think about, has the Fed talking on the Hill actually lessened the blow of next week's CPI and PPI reports, okay? Because it may be a blessing in disguise. So we're going to continue to trade the market that we're in. I'm going to leave it right there, good people. I'm going to keep this one short. We're right at 10 minutes. I gotta go and run and hit a plane, an aeroplane. But I just want you guys to stay fed. So I just wanted to hit you with just some short news. Now, here's one of the things I want to tell you about this week. I'm glad that he talked on Tuesday and Wednesday and not Thursday and Friday, because the market is still trying to decipher what's really going on. Remember, after we get this report, the market takes a few days to digest the information, right? And then it again focuses forward, right? And so we will see, I believe by Thursday or Friday of this week, what the reality of the Fed talking really is. If the market overreacted, we should be good. If it didn't react enough, or if it didn't price in what the Fed was saying, higher, faster, longer, then Friday will probably not be good. But if it has priced in, then Friday will be good. I'm hoping that the market did overreact, and I am hoping that things are priced in. But only time will tell. I said I'm hoping, I'm not predicting. All right? So, again, in closing, two things I want to talk about: the class. I already told you. Stocks with Josh is teaching us a whole chapter on charting and how to chart. Keenan Grace is showing you a whole chapter on options trading and what is an option and how do you use it. And then I got Mommy Trader is showing you dividend stock, and myself, we're showing you fundamentals. So this class is for you if you are suffering in any of these areas, or you don't know something in any of these areas. The class is still on sale. It will be the top link, and then the link below that, sorry, I'm tongue twisted, will be Webull. Today is Webull Wednesday. Deposit $1 and get up to 12 free stock for depositing $1. All right, good people, govern yourselves accordingly. I will be traveling, but I will be in touch with you guys, okay? All right, live, love, laugh, and learn. Remember, be kind, rewind, do it again.